Chapter 2 of the financial accounting textbook talks about the recording process, and we'll get into how we journalize transactions. So here are our learning direction or our learning objectives. Again, we're going to talk about accounts, debits, and credits. How do we journalize those? How does that journal then post into the ledger? And then that ledger will become our trial balance. So here it shows you a standard T account here in this corner. So the T account, we would, obviously this is what gives it its name, in that it's shaped like a T. The left-hand side is our debits. The right-hand side is our credits. And then we'd put whatever account we're reconciling or looking at on the top. So say it said cash. Any increases in cash, whoops, sorry, I keep pushing that button. Any increases in cash would be a debit. Any decreases in cash would be a credit. And then we would subtotal those to get to an ending balance for the month. If your debits are more than your credits, you would show the debit balance here. If your credits would be more than the debits, then you would just show that net credit balance there. So you take your credits minus your debits, put that balance there if it was a credit balance. Debits minus your credits, put that balance there if it was a debit balance. So again, our debits and credits are an equal system. So anytime we do a journal entry, or you're looking at an accounting transaction, there's always two sides, at least two sides. Sometimes there can be more, but we'll start out with the basics, where there's going to be two accounts that we impact in each transaction, and they always balance. And then think back to chapter 1 when I say the balance is always the debits equal the credits. But when you look back at chapter 1, we had that accounting equation where our assets equal our liabilities and our owner's equity. So you can have transactions that could be within assets. You buy inventory and you pay cash, which would just be a debit to the inventory, which would be increasing it, and then a credit to cash, which would be decreasing it. So they could be on the same side of the equation, but everything in accounting always balances out, and everything is in a proper equation type form. So if your debit entries, like what I was saying on that T account, as you're T'ing it out, if you have more debits than you do credits, you'd have a debit balance. So again, here it shows you there's more debits, there's one credit, we net them, and then our total is the $15,000, the debits minus that credit. And the same would be the case if the credits were higher than the debits, again, we net them and we show it as a net credit balance. And then these are, again, our general rules of thumb, which we'll go back to a little bit about, what we kind of talked about in chapter 1. Our assets are increased with a debit. They're a debit balance. A credit would reduce them, and our liabilities would be the opposite of that. Again, think of that equation: assets equal liabilities and equity. So on the other side of the equation, it would be the opposite. So the liabilities are going to increase with a credit, and they're going to decrease with a debit. And you do want to understand those rules, because that'll help you when you're doing your journal entry and you read it and you say, okay, they receive cash. Well, if they receive cash, it's an asset, so that's going to be a debit to cash. Or they receive an invoice and it's on account, so that's going to be, they owe somebody, they owe an accounts payable, that's a liability. I'm going to increase that, so I'm going to credit it. So even if you have to memorize those, you're going to want to do that. Then we have, moving over into our stockholders' equity, we have our common stock, which again, if we were to sell common stock, it would be an increase, so we would credit it. Retained earnings, as net income rolls into that would primarily, the normal balance would be a credit. And then dividends, when we pay those out, we're going to debit the dividends and then credit cash. And then here are revenues and our expenses, because then these are obviously other important ones that you would need to know, because those are our regular operating charges. So if we're recording our revenues, the normal balance for revenues is a credit. So again, if you're reading a transaction and you receive cash for revenues earned, you'll debit the cash side, which would increase cash, but you'll credit the revenues, which would increase the revenues. And then expenses are the opposite. And you would expect that because your expenses net out of your revenues to determine net income. So the expenses will be a debit. So if we've incurred utility expense for $150 and we pay for it in cash, we would debit our expenses because that's the regular balance for the utility expenses. And then we would credit cash because we're paying for it and cash is going down. Our statement, our income statement, and our all three of our statements kind of go together in that they have a relationship. So if you look at them, you'll start with your income statement, and I have a YouTube video where I actually work out some of these numbers, and you can kind of see how they roll when you're looking at transactions or a general ledger. So you start with your income statement and you would summarize your revenues, summarize your expenses, and then net those. So revenues less expenses is what I mean when I say net it. And then if your revenues are more than your expenses, you have net income. If your revenues or if your expenses are higher than your revenues, or your revenues are less than your expenses, you're going to have a net loss, or you're going to have a negative number. So if you have a negative number, it indicates it's a loss, which could happen. But whatever that number is, it rolls into your statement of retained earnings. So you'll have a beginning balance, which would be given to you. You'll calculate the net income, roll that in. You'll look to see if they paid out any dividends. If they paid out any dividends, then that would reduce the retained earnings, and that will calculate out to our ending retained earnings. So a business always has two choices. When they make money, when they make net income, they can either choose to keep it and retain it, or they could pay it out to their shareholders in dividends. So if they pay it out in dividends, obviously we subtract it out and reduces what they end up retaining. Then our retained earnings will roll down into our balance sheet. And again, we'll look at the accounts and we'll identify what is an asset, what has future potential for us, something that we own. We'll look for liabilities, what are payables, things that we owe people or businesses or creditors. And then what's our equity? What do our owners hold? What common stock values are out there? And then that retained earnings rolls in. And then that's your big double check, because your balance sheet should balance. That's why it's called a balance sheet. So our assets equal our liabilities plus our equity. So when you do those, if they don't equal, then you know that you've done something wrong, and it could be in any one of these statements. So then you got to go back through and double check. So here's a nice little summary again of what's a debit, what's normally a debit balance, and what's normally a credit balance. So again, if you see where the plus is, if it increases it, that's its normal balance. So an asset is a debit, the liabilities is a credit, common stock is a credit, retained earnings is a credit, revenues are a credit, expenses are normally a debit, and then dividends are normally a debit. So I feel like that's what you really want to know is what is those normals. So don't let some of these things get too overpowering where there's too much to look at. Just focus on, what is its normal balance, what increases it. So then we have our recording process where again we are going to look through and analyze the transaction so that we can determine what happened. Does it need to be recorded in our general ledger? Do we need to do a journal entry? What two accounts or possibly more accounts have been impacted? And then we'll enter that into our journal entry, and then that will go into our general ledger. So the recording process is where again we're going to actually do the journal entries. So it'll show the complete transaction, both debits and credits. It's chronological. We have our dates in there, and then again, you've got debits and credits. You want to obviously, as you're going through it, you make sure it balances. If you were doing it in a system like at work, it wouldn't even let you post it without balancing. It would tell you this transaction is not in balance. So here's an example. So on September 1st, the stockholders invested $15,000 cash into the company in exchange for common stock. And then the company uses some of that cash to buy some computers. So our first transaction, we the cash comes in, so we debit it for 15,000. We credit the common stock for 15,000 to represent the owner's investment in the company. We debit equipment because we purchased $7,000 worth of equipment and we used up cash, so we credit that. So again, this increases our cash, that decreases our cash. This increases the equipment, and that increases the common stock. Okay, then on July 1st, we purchased a delivery truck. So again, we're increasing our equipment for that $14,000. We pay cash of $8,000 now, so we credit cash, but then the remaining $6,000 goes on account. So when you see that account, it's normally going to be going to accounts payable. Sometimes there could be notes payable, but the most common one to use is accounts payable. And accounts payable is a liability, so its normal balance is a credit. So that is increasing that liability or setting that liability up in the first place. Okay, then this just shows, again, the different levels of what we're at. So when we post these journal entries, they go into our ledger. And then our ledger, again, it identifies as we set these accounts up, it knows if it's an asset account, a liability account, or a stockholder's equity account. And again, in the real world, when you're doing it, this is all computerized. So you identify in the software what is an asset and what is a liability and what is the owner's equity. So here shows you an example of the 3-column form. And again, so much of this is computerized now that you might really just be looking at this like on a computer screen. But it's showing you the different transactions. So we're in the cash account. It shows you the debits that occurred, the credits that happened, and then it gives you a little cumulative running total of what the balance is. So it started at $25,000. After all these transactions, our balance is $9,450. And then this again is showing you how it goes from the journal entry. So this was our journal entry. The first one we did was they received cash and they issued out the shares of common stock. And then it shows you how it goes from that general journal down into the cash account and then into the common stock account. So if you look at these headers, these are the general ledgers that shows you the activity by account. This gives you a chart of accounts. And again, if you were to get a job in an accounting company, normally there's always a chart of accounts. Like back when I would have gotten my first accounting job, it was printed out and handed to us. So we knew it right when we walked in the door. Everything is so computerized now that it's probably more of a lookup as you're looking at your computer. But a lot of times they're set up this way where these numbers are going to indicate, hey, this one indicates it's an asset. Any account that starts with 1 is an asset. Any account that starts with 2 is a liability. Any account that starts with 3 is equity account. Whoops, sorry. A 400 is going to be our revenues, and then now they've got various, larger numbers for those expenses. So again, every general ledger is different, but there is normally always a number associated with those accounts. So here we have, it's showing you a transaction kind of step by step. So this maps out what happened. This is just us saying, okay, well, as we analyze that, we know that cash is going up and stockholders' equity is going up. It goes back to what we learned in chapter 1, that our assets equal our liabilities and our owner's equity. So we can see that our accounting equation balances. We do the journal entry with a debit to cash, a credit to common stock, and then those funnel into the ledger. And then this is more of a summarized version that would look like what we would expect a standard T account to look like, just the basic T account with the name on the top. We've got debits and we've got credits. So it's just taking one transaction and walking it all the way through those steps. So then here's another one. We've got office equipment that we buy for $5,000 and we have a notes payable. So now assets go up, but liabilities go up. And in this case, like I said, it's not an accounts payable, it's a notes payable. So many times you'll have those. So we know that we're going to debit equipment and credit the notes payable, and that debit will funnel down into the equipment account, and the notes payable will funnel down into obviously the notes payable account. And our assets went up and our liabilities went up. Now this is a future service, and sometimes these ones are tricky, but we will have them in our homework, where we receive money in advance for services that we have not yet performed. So those are called unearned revenues. So we get the cash comes into us, so that increases our assets, but unearned revenue is considered a liability because it's not a liability of money, but it's a liability of work that we have to do. So we owe somebody. We either owe them the money back or we owe them the work, but chances are we're going to do the work. So we debit cash, we credit the unearned service revenue. And I think the thing that gets confusing for students is there's no payable. There's nothing that indicates to you that that is a liability other than that it's unearned. So you may have to kind of jot that one down and remember it because it can be a little trickier. And then now we can see though our T account's getting a little bit bigger. Now we have more transactions that are funneling into these accounts. Okay, then we pay $900 for rent. So we pay, which means our cash goes down, our assets go down, and then our rent expense is going to be our debit. This to me, that's a little bit confusing, but ultimately because it's going to reduce our net income and go into the stockholders' equity, that's why they're showing it over here. But when we come to our journal entry, we debit the rent expense and we credit the cash. So rent expense goes up, cash goes down. Okay, then now we pay $600 for a 1-year insurance policy. So this is another good example because it's one that you may have on your homework that might seem a little bit tricky. We're not going to charge it to insurance expense because it's for the whole year. So we only charge out to expense what we've used up. So this still has future potential for us. We've got a whole year to use up this insurance. So when we very first pay for it, we debit our prepaid insurance, which is an asset, and then we credit our cash, which is also an asset. So our cash goes down, our prepaid insurance goes up, and eventually when we get to the chapter that we would talk about adjusting entries, we will adjust this out to expense each month. But we don't have to worry about that right now. Just right now you have to know it's because there's a future value to it, it's an asset and it's called prepaid insurance. All right, then we purchase some supplies on credit, which again means it goes to accounts payable. So supplies go up, accounts payable go up, and we see that those go into their appropriate T accounts. Cash for services performed, these we actually earned. Cash goes up, service revenue goes up, which would increase our stockholders' equity again because it's going to eventually roll into the net income. But revenue is increased with the credit balance. So this makes our cash go up if we debit it. Our service revenue, again, is normally a credit balance, so that's making that go up. And now we have revenues of $10,000 and an increase in our cash of $10,000. We pay salaries. So we have employees, we owe them $4,000 and we pay them in cash. So that's an expense to us. It's salaries and wages expense. So we will debit the salaries and wages expense, and then we'll credit our cash because it uses our cash up. So again, you can see that funnel down into the cash account and then charge off the expense. Again, expense is normally a debit balance, so that is increasing our expenses. Then we pay a dividend. So we declare it and pay it. If we pay it, it reduces our cash, and then dividends paid are always a debit. So we debit dividends, which reduces our stockholders' equity, because like I said back on one of those first slides, the company has two choices with retained earnings or with their net income. They can either pay it back to the owners in dividends, or they can retain it and keep it in the company as retained earnings. So if they pay it out, again, it reduces the equity. Then here again is the general journal, and it's good to just get comfortable in seeing those. So you obviously pay attention to just even these little things that when it's the account we debit, we list our debit first, and then we indent over. So like if you were doing this, maybe, you would tab or, space out 5 spaces, but you're going to, move over to the next column or, tab, and that will be your credit. And then that's listed separately. So always start with your debit, follow it with your credit, indent it in. And then the same over here, you'd have a column for your debit that goes first, and then your credit goes second. And your debits always equal your credits, so that you'll look through these and they always equal. So just get comfortable with even how the journal entry is set up. Then here's more. Again, I think it goes through all of our transactions. So again, you see the debit comes first. We indent in for the credit. Debit here, credit there, entry balances. You see that all the way through. So you'll want to get comfortable with how to set those up. Then here's the big T accounts. So it's showing our whole ledger for every account that we just went through. So again, cash by far had the most transactions. So some of them only had one transaction in them. So then you look through those, and those are fairly easy. Cash would obviously be the biggest one if you were trying to kind of reconcile out and see what your ending balance was. So the limitations of a trial balance. So the trial balance will, again, you obviously want it to balance. So what it's saying here is what things could be off with it. Well, maybe there was a transaction that just didn't even get recorded. Because obviously, if you're an auditor and you're testing that trial balance, all that shows you is what they put in the system. It doesn't tell you that maybe there was an invoice or product got sent out and an invoice sent to a customer that nobody journalized and put into the general ledger at all. And again, or or there was a journal entry that was not posted, so kind of the same thing there. Or what if the journal entry got posted twice? So what if one person said, "Oh, I'm going to invoice that customer," and the other clerical person was thinking the same thing. "Oh, we need to invoice that customer," and it gets in there twice. Again, it'll still balance. It'll still look good. You just won't know. Or you could use different accounts, or you could make just offsetting errors where maybe you transpose the first number and then you transpose the second one to make it so that it balances. So there can be human error in there, that even though the trial balance looks great, human error still exists. So that is the most important thing, is understanding those journal entries and being able to do them.